Good. Thank you very much, Jonathan. Again, all CVs in the book, so I'm not going to give detailed introductions, but again, very fortunate to have Roger, who is an investor, Gordon, who I think is just about everything, but we'll hear from him a little bit later, and luckily one of these rare commodities, a willing lender into the hospitality market. What I'm going to do in terms of carrying on the theme of data is to try and see whether some of the data we're seeing at the moment is actually telling you, he said pressing which green one? That one. Where you should invest and when you should invest. And we haven't done this for a while, but I'm just going to spend 2 seconds on it before I start engaging with my panel. We normally look at the bottom of troughs to see what has happened since over the last upcycle. So if I look back at 2008, which is when it all started to go wrong, the good news is that if you'd actually stuck and held on to your assets and not sold them at that point, you will be looking at a point now where your assets are worth considerably more. However, there is a variation. Clearly, North America and Asia Pacific, the two markets which have performed much better than Western Europe. So what I'm going to do is explore with my panel from a geographic perspective whether they think this is right. Now again, I've concentrated on the major cities here, the 15 top global gateways, which is normally where investors from this region tend to concentrate. But again, we'll test it. We'll see whether that's still the case. These 15 top gateways tend to get a significant amount of the inward investment. And if I look at 2015, you can see the numbers there of where the global gateways came in. It was about $23 billion. Again, we are looking at a slightly different trend when we go into, sorry, that was, yes, 2015, 2016. We are seeing that there is a little bit of a cooling off there, but we also have to strip out certain exceptional transactions which took place in 2015, such as Mayborn in London, which again I doubt whether we're going to see repeated again, and also the Waldorf Astoria in the US. Now, sorry that this is small, but again, going back to the data, do the volumes actually tell you anything about values? Is there any connection between the two? The only connection I've been able to see is that those lower liquidity markets tend to have greater proportion of long-term holders, and they see more volatility in transaction values because less gets traded. So if you get a one-off deal happening there, it'll skew the data massively. The only two exceptions to look at are London and New York, where again, because we've got less volatility in transaction values, we tend, those will be the markets that investors tend to want to invest in. It's clearly at the lower end. And also, when we look for this proportion of the global gateways in terms of the global transaction volume, I mentioned 2015. So now in 15 markets, we're seeing 55% of all the capital which is going into hotel transactions going into these gateways. One other thing, does RevPAR tell us anything about when to invest in a market? Is there any correlation between performance in RevPAR and transaction values? The answer is it's pretty weak. Again, there probably isn't enough liquidity out there for us to get a consistent trend. The only two markets where there does seem to be a fairly strong correlation are Sydney and San Francisco. But you even see some locations like Munich where it doesn't come anywhere close. And that thing about timing, can you pick the perfect moment to invest? And what it seems, particularly as far as the global gateways are concerned, is it's not worth the wait. Here we're just looking at how transaction values have actually performed in relation to RevPAR, and there doesn't seem to be much connection. So, on the basis that it's probably better to go and dive into the market immediately, my first question, and starting with you, Roger, is are you actually a buyer of anything at the moment?
Am I a buyer? I think we could be. I think that my preference right now is really focused more toward North America than Europe. I think Western Europe is a good place to invest in general, but we're a bit more dividend focused. So we look toward North America for that. I think we can get higher yields and better dividends. I think if you're after capital appreciation or long-term capital growth, Europe is a very good place to do that as well. But in our case, we're a little bit more focused on dividend for the moment. So.
And you, Jerome, you were mentioning briefly that you have been a very active lender in the hotel space. Clearly, you mentioned both sides of the pond as well. Just give us a sense of what you've been doing in the last 12, 18 months.
I think what we've seen is effectively a strong increase of transactions on our side in Europe, which was quite weak 2 years ago, and has increased a lot over the last 2 years, and quite balanced, which was a bit surprising to us, but quite balanced between high-end hotels and budget hotels. Very different profiles of investors, driven by real estate or by cash flows, but I think we've seen both and in volumes, which was the very big difference compared to, I would say, prior to the crisis. Reduced, so far 2 years ago, reduced liquidity. I think we were among the first one to lend with a couple of banks, and we were having sometimes hard time to syndicate our deals. And over the last 2 years, I think people and banks have followed their clients, which have been more and more active in the sector. And I think today and last year has been a particularly good year in terms of liquidity on the market. That has been a big change in Europe. I would say in the US, on the lending side, it has been always very active, but maybe people started to be more cautious on the lending side now because of the values, whereas it's not yet the case in Europe.
And Gordon, I guess you've been all sides of the coin at the moment. Are you still buying?
Of sort, yes. I think we're investing in what we know, which is ourselves. A tremendous amount of capex at the Georges V in Paris, at the Savoy, and hopefully the Plaza. We're investing some more capex in our Far Eastern hotels, where some of the occupancy fall has allowed us the opportunity to put some money to work there. We are providing liquidity to some of our minority partners in hotels in the Middle East. And also, I think importantly, we're taking the opportunity with excess capital to actually pay down some of our expensive mezz debt. I think everyone is at this point in the cycle is probably thinking that equity returns are going to be in high single digits if we're lucky, and I think why not invest in the mezz debt by paying it down that is at those high single digits in terms of interest. So that's where we're spending our money right now, as well as the investing in Accor, which I think everyone will know that transaction with Fairmont will close quite shortly. The antitrust has been completed and will close halfway through the year.
Well, congratulations on that. We'll come back to the whole issue of corporates. Now, I think what I've heard fairly consistently from the three of you is that income seems to be rising up the level of importance. And Roger, you started off with the comment about dividend being more important. Where do you think we are in the cycle? Because my sense is that when investors start concentrating on income, they think we've probably peaked or plateaued or whatever appropriate word you want to do. What is driving you to focus more on income than other aspects?
I mean, I think that we've just always been income investors. It's just always been a priority to us to be able to have solid cash flow, and that would give us, room for some compression when we have downward movements in the market overall. But I think that in terms of where we are in the cycle, I think if you look at North America, I think we've got a couple more years to run. I think it's probably peaked in terms of value already. But I think that right now we're starting to see some opportunities that are emerging because people have already bought, and some people are afraid that they want to get out before the next cycle, let's say. And so the cap rates are once again rising a little bit. The cost of debt's rising a little bit. So we're seeing some opportunities again in some markets that we previously thought were too expensive. I think the gateway markets are still very attractive, and I think if you get a buying opportunity at a slightly higher rate and you're a long-term investor, that's perfectly okay. San Francisco, New York, etc. I think you simply choose carefully exactly where you are and just go for it for the long term.
So for you, a sort of a 5 cap on a New York asset is more interesting than an 8 cap on a Chicago asset or whatever it may be?
Not necessarily. I've been spending a lot of time looking at secondary markets. So these would be things like West Coast, as well as, let's say, Denver, Seattle, some of the markets in Texas, starting to wonder a little bit about Houston, which is beaten way down, but yet I think we all can believe that the energy prices will rise again and that maybe there's some opportunities there. Those yields are high, and but I think if you if you are, let's say, outbound investor from here and you're wondering about gateway cities in North America, I think there's still very strong fundamentals there and good investment opportunities. So. Yeah.
And Gordon, I guess that most of your assets tend to be in core prime cities, that the larger ones. But what's your view on secondary markets at the moment? Do you think they're offering fair value for money, or do you prefer the big uns?
I think if I was an investor with a 10-year horizon, I think getting into some of the emerging market gateway cities, whether it's a Rio or whether it's a Johannesburg, there's some in the Far East as well and some in Eastern Europe. I think that would be where we would be deploying our money into hard physical assets if we were allocating funds directly into into that segment. We're very much more concentrated on the asset-light management companies currently. But I think there are definitely, in the emerging markets right now, opportunities for the gateway cities within those emerging markets for, if you have a 10-year horizon and beyond, you'll make very good returns on that.
The barriers to entry in those cities tend to be rather hard to read, but clearly new supply can come at very high speed there. What are the other risk factors that you think might be out there?
Well, we've spent the last 10 years building in some of these markets. And whilst urban planning is sometimes difficult, so you don't know when you're building, whether that's going to be the CBD for any length of time and so forth. But look, it's so hard to build in these places, and as long as you can do it well, sometimes with or without a local partner, you create to yourself the barrier to entry, because your product can stand out a mile from everyone else. And it will still take 7, 8, 9 years for anything of similar quality to come into that market.
Now, just from a lending perspective, again, I hear from my colleagues in the US, and you've just mentioned it, that it's a little bit harder now to source debt than it was this time last year. Give us a sense of what's happening in the CMBS market, because I think that's the main driver, is it not, of liquidity?
Yeah. CMBS market has been quite volatile. I think a strong adjustment of prices Q3, Q4 last year, and we have seen many banks who have underwritten deals at a certain price and forced to sell through CMBS at par or below par. So that means that it was our time, and what we've seen is that there was, and some of our clients just refocus on the financing from CMBS types of approaches to pure balance sheet approach, which is much less volatile. But the issue is that the bankers on balance sheet, again, are being more stressed by the value today. So they are very selective in terms of the type of situations they will be considering. And I think we come back to, even if we are talking about non-recourse lending, one of the key things is the sponsor. And that remains the key.
And just, again, in terms of the asset types, we've been talking about prime gateways, secondary markets. Do you, as a lender, have a strong preference for either, or does it tend to be what your client brings you?
No, I think, experience in particular over the past, let's say, 10 years has shown that for us, we like, I would say, trophy assets in the capital city centers. there is always some, even if the performance at some point of time is impacted, there is some recovery potential which is there. And as a lender, if you can have a medium to long-term value, it's going well. The second situation, which has proven to be resilient, is looking at secondary locations in countries having a strong domestic business. If I'm taking an example of Germany, for example, what was very well performing over the past years was portfolios of three-star hotel in the regions, because domestic business has remained constant in Germany, so you have a constant level of performance. Maybe that's not the most attractive type of situation for investors who are looking for capital gains, but if you're looking for stability of cash flow, that's a very good investment, I think. And from a lending perspective, that's a very good situation.
Okay, thank you. I want to bring the discussion around, and Gordon, you touched on it, the whole topic of consolidation. I'd be interested in your take, and clearly we've seen the two big ones, of which yours is one, and we mustn't forget the Xinjiang Societe de Lu. So we've had 3 large transactions be agreed and be closed fairly shortly. Do you think this is the beginning of the wave, or are we going to catch our breath and wait and see what happens? What's your expectation?
I certainly wouldn't be surprised. I think the Marwood, our transaction has certainly set a benchmark for people and left 1 or 2 companies behind. And I think there may be a scramble for those to look to do something of material size. But we all know that this is a lot to do with the reaction of the industry to the OTAs and the pricing power that they have, and to a lesser extent the sort of the Airbnbs of the world. So as long as some of these companies are paying nearly 20% fees on their OTAs commissions, then there'll be a push to continue that consolidation and drive size and abilities to invest in technology, abilities to buy the first page of Google, so you're there and promote the brand.com. But that's not to say niche players, 100 hotels and so forth, won't be there to play that market. But I think the big guys that are sort of $3 billion plus, there'll be a lot of pressure on them to sort of join together.
And because you sit both sides of the fence, what's your sort of perception as an owner of an asset? Do you think there is going to be a benefit in this from a capital value perspective, profitability perspective?
Yeah, I think we've done some analysis on that. I probably won't disclose everything, but I think for the general owner, I think it'll be very positive. Again, the distribution channels will be so much better in a combined Accor-Fairmont than Fairmont was able to undertake on itself. The investment in technology, the OTA fees coming down. There are many different areas that I think that margins will improve as an owner, and most of that will fall to the bottom line of the owner. So we're very comfortable that we'll see some marked improvements in the performance of our owned hotels that are managed now with the Accor platform behind it.
And Roger, if you then looking at assets in secondary markets, it means you have to buy something that is branded by one of the majors, doesn't it?
I think so. I think the brands add a lot to the asset in general. It is crowded space sometimes. There's too many branded products, and I think the industry has tried to kind of reinvent some other options there. So some lifestyle brands, boutique hotels, all of these things. But ultimately, there's even brands behind a lot of those now. So, but I think that in terms of the consolidation, I don't think it's great for the owner overall. I think it will help with the economics of cost of reservations and things like that, and the OTA issues. But I think that ultimately it creates issues with where you may have had radius agreements and things like that to protect your your business trade area. I think it will also have a negative impact just on management agreements and negotiating fees, things like this. Got less competition ultimately with some big brands coming together, so maybe that'll be more difficult. So competition is really the name of the game in terms of trying to get management fees to remain low. So.
And Jerome, do you think the lending community starts to differentiate in pricing debt between things which are well branded and emerging? Is that something you think about at the moment?
Yes, I think I mean to rebound on that. Yes, in any case, you have to take into account that the lenders, they love stability, they love efficiency. So in any case, everything will be pushing in that direction, will be positively perceived by the lenders. Now, what you have to consider as well, I mean, I think there is, again, we're starting from a point where in the bank community, not all the banks were considering hotels because it was perceived as a too volatile business. Things are changing. I think what we're seeing in terms of effectively big players emerging, in terms of some standards emerging, will help definitely sourcing liquidity on the bank side for the main players of that market. So that's definitely the case. I think that's something which may, which may not be the main purpose of investor, but from a bank standpoint, everything which reduces uncertainty, which provides stability, is a good point.
Okay. Just want to also touch quickly on the public markets as well. And again, Roger, going back to North America, we've seen the REIT share prices have a very rocky time recently. But bearing in mind that investing in portfolios tends to be a better way of preserving returns than going off and picking single assets. But do you think now that the REITs are going to become is there a way of making a REIT a more efficient instrument in which to invest in? Because at the moment you buy an asset for 100 and it's worth 85 the following day when it's in the public market vehicle. What's your sense of the future for REITs? Are they past it? Is there a different way? Do you like them at the moment?
I would say yes. I think that REIT investments are good ones. They're a little bit more tax efficient than doing direct purchases yourself. You defray a lot of the tax considerations, and also for a foreign investor, from a capital gain perspective, you're much better position. But I think that they're going to increase in popularity again. I think there's a lot of small to medium sized investors that are quite happy to own shares that are very liquid in a REIT, and there's a lot of even non-public REITs that are attracting foreign capital as well on a very tax-efficient basis. So, yeah.
Good. Well, before I throw it open to the audience for questions, I just want to ask one particular question. And Gordon, you touched on the higher risk markets that you'd like to be involved in, but Roger, we've been fairly conventional so far in terms of picking, but where would be your pick of the city to invest in now that you'd like to get greater exposure to?
I think that there are some markets in the U.S. that are becoming major markets, and they might not be gateway, New York, Los Angeles types of places, but I think over the next 20 to 30 years, these are markets that are growing very, very quickly. You have places like Charlotte, North Carolina, certainly Denver, Nashville even is growing tremendously, and I think that investments in any of those areas, whether it's in hospitality or in other types of investments, residential, office, etc., are ideal. Denver also growing very quickly. We're getting a lot of people moving from California, where it's, I would say, very expensive to live, etc., that are still want the Western lifestyle. We're seeing that area grow a lot, and so I think any of those are very interesting. Charlotte, Denver, possibly Seattle. So. Gordon,
you mentioned some South American ones, but again, is that the one if you had to pick?
No, I think if I was a 10-year plus investor, I think it's 3 or 4, maybe a handful of cities in Africa. There seems to be a lot of capital going there, and those capital markets are growing. And I think all these individuals that have made a lot of money in the commodities realize they can lose a lot of money in commodities, so they'll be investing in real estate to sort of have the capital preservation. And I think with the jitters in the Far East with China and so forth, I think there has been for the last sort of 6 months some quite good deals probably to be had in some of those markets in the Far East as well. So I think that there are markets globally that as long as you have the long-term horizon and some of the skill set, you shouldn't necessarily just be what Roger does and look at Charlotte's and all of this world.
Jerome, I know you obviously don't have the capacity to go off and lend in Reykjavik or wherever it may be, but in terms of these markets you're looking at the moment, what is the one that you think is the best pick?
I think for people who are not shy about making some CapEx and repositioning hotels, I think Southern Europe is a place where I think there have been no capital invested over the past 8 to 10 years. So for people who have some money and still want to find a good mix between business, tourism, there are some opportunities in that area. And I think interest liquidity on the equity and the debt side is coming back for these countries. So there is still some good deals there in my view.
So just before we sweep up, any questions for the floor for the panel? Good. Well, before I go, I have to say, Roger, we need to see you because we've got some very nice assets for you to buy in some of those markets that you've mentioned. But my closing question to you is, of all the deals that you've looked at over the last 2 years, and I'll run down the line, what's the one that you wish you could have done?
That's a good question. I would have to say probably some of the things I've seen in London that I've underestimated just how much growth there is in that market and how much more it could go up. So, yeah.
Yeah, I think with the compression of yields in Europe, I think 2 years ago you would have made quite a lot of money on your capital if you'd put money to work in some of the European cities.
Jerome?
And I think as a lender, we missed a couple of deals in New York in particular that we would have loved to do, and I think today would be more difficult to do, to be frank.
Brilliant. We're out of time. Thank you all very much indeed. I hope that gave you a good sort of high-level flavour of what's going on in the markets, but thank you, panel. Very grateful for your thoughts.
Okay.